Well, hey, welcome back. Joined with me again is Casey Hazen, Senior Portfolio Strategist for Horizon. We have had a crazy summer, haven't we, Casey?
Absolutely. It's been a very busy start to the year, and I can't believe it's already or it's more than halfway over at this point. We're in the second half of 2024. I can't believe I'm saying that out loud.
Yeah, I was sitting in a meeting recently where that came out about how quickly the first half of the year has blown by. So, and
Absolutely.
with that pace and rush, the market's done actually pretty well. We've had, I think it's the S&P is up close to 15% through the first half of the year, and I think the market's kind of blown out most expectations so far. So, um, with that said, with the market doing so well and the second half of the year having some question marks, is there anything that you want to go over today? Anything in particular that stands out for you, Casey?
Yeah, no, absolutely. The market has absolutely exceeded expectations so far this year. I think coming into the year, we were optimistic on the equity side, thinking the market could be up 10 to 15%. And obviously, like you just said, we got 15% in domestic equities in the first half of the year. But a lot of that kind of outperformance that we've seen is on the back of a really, really strong economy, an economy that continues to outperform expectations. And kind of jumping forward, one theme that we've been talking about, you and I, over the past couple of quarters here, is there has been concern of a slowing economy. We've talked about the idea that the economy is slowing, but it's definitely not depressed by any means. One factor within kind of the slowing economy is the labor market does continue to, like this title here says, cool down. But by no means is it a cold labor market. We're coming off of a really unique period where, on the left hand side, we see job postings. There were about two open jobs for every unemployed person. You see that's come down to a more reasonable level. And on the wages side, you can see the wages have absolutely cooled down. But really, we're just back in trend with where we were prior to COVID. And we think that that's a really important thing, the idea that the labor market is softening, um, because over the past couple of years, we're in this period where wage growth was absolutely kind of blowing out expectations. And there was, like this title up here says, this fear of a wage price spiral, or the idea that higher wages beget more inflation, which begets more high wages. And so you can see over the past handful of quarters and the past handful of months, wage growth has absolutely cooled down to a much more normal level. We think that this 0 to 2% wage growth on an annual basis is kind of this sweet spot for an inflationary environment, somewhere in like the 2% target, which is what the Fed has been targeting longer term. And obviously, we just had a recent CPI print that came in a little bit softer than expected, around 3%. So we're not all the way there, but these lower wage growth that we're seeing, these lower wage growth numbers that we're seeing, are absolutely helping that side of the equation.
So, I know that wages have been a big part of that inflation picture in our economy, but I also know from what you and I have discussed, the consumers play a huge role. And so I think that during our last investment committee meeting, we were looking at maybe you have that slide teed up. It was showing how much excess capital, how much liquidity is sitting on the sideline for your consumer. So they may be in a little bit better position. It could be the upper echelon, the more affluent who are saving, but at the same time, there's still a good bit of cash on the sideline. Do you have that? There we are. Yeah, I see that now.
Yeah,
Can you speak to
yeah,
that a little bit,
absolutely.
Casey?
Yeah, absolutely. Over the past, many, many quarters, we've been talking about just how strong the consumer remains. A big part of that is just from a balance sheet standpoint. They've been pretty flush with cash, especially coming off of COVID. There was all the liquidity that was injected. There were checks, individual checks that were sent out to families. But beyond that, there was a whole lot of saving that went on during that period, just because the economy essentially shut down,
Mm-hmm.
and so you couldn't spend as much, and so there was a lot of savings that happened over that time period. a lot of the savings, on the lower echelon of the wage earners has definitely come back down to more normal levels and maybe even slightly depressed at this point. But from the data that we're seeing, and again, this comes from the National Bureau of Economic Research, um, there's still $4 trillion in excess cash and savings, based on this trend line that we've been experiencing over the past couple of decades. So there is a lot of cash sitting on the sidelines. While maybe not all of this $4 trillion makes it back into the real economy, higher income earners don't necessarily spend all of their savings. A lot of it goes back into their financial portfolios. What this $4 trillion sitting in cash right now does represent is maybe a potential tailwind for the financial economy, right?
Yeah.
Cash and CDs and money markets do look attractive right now just because of the high yield environment. With expectations of yields coming down, we do expect that a lot of this $4 trillion does get reinvested. And again, that's going to be another tailwind for just investment portfolios, equities, and fixed income moving forward.
So I know one of the things we touched on earlier was um, having to do with inflation, right? And so one of the concerns that I have clients who brought up to me, and they just kind of keep pointing to, um, inflation still being a problem. And one of the things that you and I discussed is trying to break down what inflation actually is, right? So inflation is a rate of growth, and inflation, let's say assets or the cost of eggs or milk went up by 10%. So inflation means that it went up by 10%. Inflation can subside, but that price can still stay high. And so when people say inflation is still a problem, technically, if inflation is no longer growing, if those prices are expensive but they're not continuing to grow, then inflation is no longer the problem. Pricing would be more of your issue. And so, can we kind of touch on that about how people kind of misread that and mentally how the mindset is versus what's reality?
Yeah, no, I think you laid out the example very, very well. Um, this is probably one of the biggest reasons why people are so negative on the current economy, is the experience that we've had over the past couple of years is just rapid price growth everywhere you look, whether it's at the grocery store, whether it's if you're trying to buy a house, whether it's if you're trying to buy a car. Things are just much more expensive than they were 3 or 4 years ago. And so while if you ask what's the rate of change over the past year, things are definitely starting to cool down. By no means is the absolute level of prices coming down, and that's exactly what this purple line and the red line represent. Is the actual rate of inflation versus like the absolute change in price levels over the past 3 years. There's a huge divergence there. So when people say, economists may say that inflation is coming under control, that doesn't necessarily mean that price levels are coming back to where they were prior to COVID. It just means that they're not as expensive or they're not growing as rapidly as they have been over the past couple of years. Quite frankly, Chris and everybody, we're not going to get prices moving back down to pre-COVID.
Yeah.
And honestly, that's probably a good thing. We don't want massive price cuts
Yes.
across the economy. That's deflation. Deflation is a very bad thing and a very scary thing for an economy, and it's something that policies, whether it's from the Federal Reserve or just other parts of the government, can't really address deflation like we can inflation. So the fact that we're getting moderate inflation at this point just leads to another indication of a healthy and a strong economy right now.
Yeah, so I think it definitely seems like the Fed has themselves painted into a corner a little bit. You would think maybe cutting some interest rates could be beneficial to make the markets move higher and access to capital a little bit cheaper. But right now, then cutting interest rates could have other consequences. And so
Exactly.
I definitely don't envy their position right now. It's a challenge. And so from what I've seen, it's the belief, and I don't have academia and actually stats on it, but it seems like with us refinancing several trillion of our treasury debt this year and printing about $1 trillion every 100 days, that could lend itself to more inflationary pressure than anything else. Is that kind of a consensus that there's, may not be as bad as a couple of years ago, let's say, but at the same time, it could just keep the prices a little bit higher, maybe some inflation in other areas as we continue to print dollars. Is that pretty consistent from what you guys have seen as well?
Yeah, no, absolutely. If you think about the path for interest rates going forward, we do think that interest rates are going to move lower, but we don't think that interest rates are going to move back down to where they were again pre-COVID or the early stages of COVID. Interest rates are not going back down to zero, and we think again that's probably a good thing. So maybe not as much support on the way down, but again, to your point, the Fed has backed themselves into a bit of a sticky situation, and they're doing kind of everything that they can to keep their dual mandate, which is stable prices or just stable inflation and a healthy labor market
Right.
intact. And right now, they've struck that balance, but it's a little shaky to say the least.
I'm tracking with you. Well, speaking of the season that we're in, I've got a lot of clients asking about how do we take risk right now ahead of the election, the potential for this to be a contentious type of election, and all the different, media things that can influence people and people just being people. So I'm wondering, um, what is statistically, what's the take on politics as it relates to election cycles in the stock market? I think we have that. Yeah, you've got it teed up here perfectly. So, Casey, do you
Yeah,
want to speak to that a little bit?
absolutely. And tis the season to talk about politics and how it relates to investing. And I think we talked about it maybe even last quarter. There's a very strong historical relationship or lack of relationship between who wins the general election and whether it's a split or divided Congress, and the actual investment market. And this chart here, there's a bunch of numbers that are showing up here. This is from our research partners over at RBC. And essentially, they asked all of their different sector and industry analysts what their expectations are for their industry outlook, whether it's a Republican that wins the president, whether it's a Republican sweep, whether Democrats win, whether it's a Democratic sweep. How does that different scenario impact your outlook? And just at a high level, yes, there are maybe some winners and losers, but at a very high level, it's broadly good. Like the outlook for all industries, for the economy, for the markets is broadly good going forward, and a lot of that doesn't have to do with this election that's coming up. Basically, these red lines here, anything above that is going to be a bearish outlook. Everything below that is going to be either neutral or positive. And so you can see across the board, whether it's Republican sweep, Democratic sweep, split Congress, the majority of the outlook is positive or at the very least neutral. So from everything that we've experienced and everything that we know, you shouldn't go ahead and change your investment portfolio based on this one election or this one event, because history would tell you that it really doesn't bear much in the way of investment outcomes, who wins or loses. Maybe we're definitely likely to see some more volatility leading up to the election, but we think that volatility shakes out fairly quickly after the election. And like we've talked about throughout this entire webinar, the economy is in a pretty good starting place right now. So we do expect that becomes the real driver for your investment portfolio going forward.
Speaking of drivers for the investment portfolio, Casey, I think it's important for us to talk real quick about stocks versus bonds in an inflationary environment. In the last 4 to 6 weeks, I've had a handful of clients calling in just worried about politics, worried about all of the different pressures, and saying maybe we should increase our bond positions. And so that would be, historically your diversifier. If you're leaving equities, you head towards fixed income because of the way they work together. But Casey, I think it would be important for you to speak to how in an inflationary environment, adding more bonds could just add potentially more volatility and more risk. One of the things that, here's the punchline, is that we've been running a few different alternatives in our models already, but there's a few that we may need to evaluate in the coming months. Maybe, what do you think, in 6 to 12 to 18 months, we may need to add some more, potentially, depending on what develops, of course, some more alternatives, because stocks and bonds may not be enough from what we've seen historically with inflation. Casey, what say you on that?
Yeah, it's a really interesting and kind of nuanced point. But this idea that bonds always diversify a portfolio because bonds are always uncorrelated with stocks is just not true. There are many periods where stocks and bonds are positively correlated, and you can see a lot of that had to coming out of the 60s. Obviously, there was a pretty inflationary period back then. And then in the early 2000s, we actually had this switch where the main focus wasn't necessarily on inflation. In fact, over the past prior to COVID, over the past couple of decades, the Fed would have welcomed any sort of inflation just because it was nowhere to be found. But in that period, the primary concern that the Fed and the economy was really facing was some sort of deflationary shock, and I mentioned deflation earlier. It's a much larger concern, especially for like people, the policymakers like the Fed face. And what we've realized is that in periods where inflation is the major concern for the economy, stocks and bonds tend to be more positively correlated versus where deflation is the primary concern. A really kind of more recent example of that is in 2022. That was obviously a period where inflation was a major concern. That's why the Fed was raising interest rates. And we saw both stocks and bonds sell off pretty meaningfully together. And so going forward, while we think inflation is coming more under control, inflation tends to the concern about inflation tends to persist, especially in the minds of policymakers and in the minds of Feds. So going forward, even if inflation is under control, they're going to continue to be worried about it. So as long as the Fed continues to worry about inflation and it's on the back of their mind, we expect the correlation between bonds and stocks to be a little bit more elevated. Not maybe not to the full extent that it was in 2022, but it is going to continue to be a concern. So we do think this idea of being less reliant on traditional fixed income to fully diversify your portfolio needs to be you need to think about that. And to your point, Chris, we have been incorporating some different types of strategies, alternative to fixed income strategies, more particular risk mitigation strategies that are fully unreliant on direct fixed income as a way to hedge some of the downside risks. And those are the types of strategies that we think will become more important going forward. Again, as long as inflation is the biggest concern to the economy.
Yeah, yeah. Also, speaking of which, of strategies, I know it's difficult to say because every single client account is different, and the pricing and timing of how a model is either reevaluated or rebalanced can be different on an account by account basis. But if my recollection serves, at that time, just holistically, day in and day out, when we made those changes over this past 90 days, this past quarter, I think it was maybe 5 or 6 out of the 8 changes all had added value somehow. So all of them will be a little bit different, whether it's taking less risk and getting a better return, or how we changed a few different pieces of the portfolio that actually did add some value based on the metrics that we track. That was really hopeful. And so I know this quarter we're not looking to make a bunch of changes, but let the ones that we'd already made kind of ride to see if they continue to bear good fruit. And so it was very positive about that. Again, every single account's different. You may have 4 out of the 8 that are profitable. Some people may have 7 out of the 8 that are profitable. Just wanted to give you generally that from what we see at a 30,000 foot level, that the changes that we've made, at least for this last few weeks since we've been evaluating it, have been worth the wait, worth the while. So, Casey, anything your way before we part company for this quarter?
No, I don't think so. I think we touched on everything. Again, our outlook is still fairly positive. We do expect some volatility leading into this next election period. Again, it's not something that we're necessarily looking to make changes because of. We think that it just kind of comes with this time of the year. So if you see markets swinging, don't necessarily panic. just know that it kind of comes with this every 4 year time of the cycle. So overall, things are definitely looking pretty positive in our view.
That's good. That's good. Well, thanks, Casey, for joining us as always. And thank you for those of you who've tuned in. We will see you here in just a few months for the third quarter. In the meantime, as always, if you have any questions, give us a call at 678-884-8841. You can check out our website at findabundance.com. And if you'd like to connect via email, it's connect@findabundance.com. In the meantime, have a great rest of your summer. We'll talk to you guys soon.